Folks, this episode, like every Paisa Vaisa episode, is for education and information only. Views expressed are opinions and not advice. Please consult an expert for your financial decisions. Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and this is a really special episode for many reasons. First of all, we've got a policy research institution on our show for the very first time. Second, well, we're going to cover BNPL, which we have in the past, but this is going to be from the customer's perspective. A lot of insights out here, folks. You want to be listening in. My guest, Dr. Indradeep Ghosh, Executive Director of Dvara Research. Stay tuned for all of this and much more right after this short break. And welcome back. Dr. Ghosh, welcome to Paisa Vaisa. Thank you so much for doing this for our listeners.
Thank you for having me, Anupam. Great to be here.
Fantastic. Doc, so tell us about Dvara Research. That's DVARA, Dvara Research, and also about yourself, please.
Sure. So, Anupam, Dvara Research is a non-profit research and policy advocacy foundation organization. And not only are we non-profit, we are also non-revenue generating, which means that we don't generate any revenue from our work. Whatever research we produce, we put out in the public domain for everyone to access freely. And we also do not do consulting engagements, even though we have a lot of expertise. We could be doing a lot of consulting work, but we don't do it. And the reason for taking this kind of approach to our work is that we are doing policy advocacy for the customer, for especially the low income, the poor customer, but really for all retail finance customers. You know, our work has implications for the full spectrum of retail finance customers because the regulator does not distinguish between retail finance and poor retail finance and middle income retail finance. We believe that our work has implications for the full spectrum of retail finance customers, but of course, our specific concern is poor customers because it is with poor customers that financial inclusion and social protection are important policy levers that the government is using. And since 2008, the model for Dvara Research has been the same model we have for the last 14 years, remained a non-revenue generating, non-profit research and policy advocacy organization. We think of ourselves as the voice of low-income households, and we advocate for their financial well-being. We are a small but very effective team. We are well known for our work in India and abroad. And we are really passionate about working in public policy, in creating change. We have engaged with all the financial markets regulators, various government ministries that function in the financial inclusion and social protection domains, like the Ministry of Electronics, Information Technology, the Ministry of Finance, etc. We respond to their regulatory and policy announcements, and we are also sometimes invited by them to contribute research on specific themes. For instance, recently, one very key contribution that Dvara Research made was to the social stock exchange. You may know that SEBI recently announced the framework for the social stock exchange. In fact, Dvara Research was the drafting team for the working group report on the social stock exchange. We sat in on all of the working group meetings, we took notes, we provided much of the research material that the working group deliberated on, and we also wrote up the report, of course, with the working group's guidance. So this is the kind of work we do. Of course, we'll get deeper into the kind of work we do. My own bio, I am trained as an economist. I have a PhD in economics from MIT, and I've worked and lived in the US for almost 2 decades. I, of course, grew up in India, but I left India at the age of 21. I worked and lived in the US for almost 2 decades. And I returned to India in 2015, so about 7 years ago, to start up a new postgraduate academy in Mumbai. And after returning to India, I got interested in policy problems in India, and I started working on those policy problems. And then I felt the need to transition out of academia. So I had been an academic for pretty much all my career. I felt a need to transition out of academia and take up more of a role that was closer to the policymaking arena, but I wanted to remain in a research-focused role because research is what I'm really trained to do. And so that brought me to Dvara. I have been at Dvara in the Chennai office from 2019. So I've been with Dvara for about 3 years.
Wow. I mean, kind of I'm just trying to think when was the last time we had a PhD from MIT or an academician with such a deep background on our show. That's what's going to make it a lot of fun. Dr. Ghosh, tell us about Dvara does a lot of research on really diverse topics. And of all the things, why did you choose BNPL as an industry on which to do a fairly comprehensive report, again from the customer's perspective?
Yeah, see, I'd like to give a little bit of background to your listeners so that they understand what we do and why we do what we do. So, for the last 15 years, and then it will become clear why we picked up BNPL, because BNPL is a very topical issue, but it stands within the context of our larger body of work. So, for the last 15 years or so, like other developing countries, India also has been relying on financial inclusion as one of the main levers for improving the economic condition of the poor. In a way, you could say that India has been at this since 1969. Indira Gandhi nationalized the banking system in 1969, and then there was a slogan that she also used in her political campaign called Roti Kapra Makan. So those were at that time the aspirations for the poor in India. There was a Garibi Hatao kind of approach in the policy making arena. Then in 2003, so I'm fast forwarding, in 2003 with the BJP state elections in Madhya Pradesh and some other parts of the country, we witnessed a new slogan, Bijli Sarak Pani. So electricity, water, and roads. And then about 10 years later, 2013-14, we got even another new slogan, which was Jandhan Aadhaar Mobile. So all in groups of threes, but you can see how far the country has moved from 1969 to 2014, from Roti Kapra Makan as being aspirational goods for the poor to Jandhan Aadhaar Mobile. So already you can see over a period of 40 years how much progress the country has made economically, that the poor now are considered to be eligible or should seek to should aspire to owning a Jandhan account, an Aadhaar number, and a mobile phone. So financial inclusion, and especially digital inclusion, which is basically allowing the private financial sector to offer products and services to both the urban poor as well as rural populations via digital channels, and not only through digital channels but through digital ID authentication systems. This is the major thrust of India's developmental agenda for the last 15 years or so. Now, where do we come in? The question we ask is, are the lives of the poor actually changing as a result of all of this policy action? It is possible that the poor are not only benefiting, but they are actually worse off, because now financial inclusion policy is allowing for-profit enterprises to extract a financial surplus from the lives of the poor. So this is where we come in. All our research is focused on understanding how financial inclusion is playing out on the ground, as it were. And credit is a perfect instance of this, because most of the financial inclusion story in India so far has been a credit story, not a bank account. Or even though Jandhan has spread throughout the country, a lot of Indians own Jandhan accounts. Those accounts are for the most part dormant. So it's not been a bank account or a payments or an insurance or a retirement products or an investment product story. Mostly the financial inclusion story in India has been a credit story. Our research shows that there has been an explosion of credit offerings to the lower income segments over the last 15 years or so. And while this has surely benefited a lot of low-income households, it has also created problems. So, for example, there is a persistent condition of over-indebtedness, debt distress in pockets of India. And from time to time, it bubbles to the surface. We see farmer suicides like in Andhra Pradesh in 2010, recently in Assam. So from time to time, it comes into the public consciousness, but there is a persistent condition of over-indebtedness, debt distress in pockets. So this is why BNPL was very interesting for us to look at. From an inclusion perspective, here is a new kind of offering that has some promise. But from a customer protection perspective, the question we have to ask is, does this benefit the customer? Or rather, what possible harms could this kind of product offering be inflicting on the customer? Because the low income customer is always hungry for credit. There is always unmet demand. So the question to ask is, just because there is demand, should supply respond? And if so, then what makes for an appropriate supply response and what doesn't? So this is the kind of research angle we pursued with BNPL. BNPL is a big industry today in India, 25 million customers in India in 2022. They are marketed as a little to no cost substitute for credit cards. There are approximately 77 million credit cards in use in India as of May 2022. So the scale of the industry, the BNPL industry, has so quickly increased that we thought that this was a very important product offering to look at and to do research on.
It is, Dr. Ghosh, because even on Paisa Vaisa, we've tried to cover a lot of different topics. We've had financial inclusion, we've had firms like Pension Box, who provide pensions for the vulnerable sections of society. And on the BNPL side, we've had the providers like Capital Float and Simple on our show. But you obviously provide us with a very, very unique perspective, which is from the customer, and that also from people for whom credit is a lifeline, and therefore BNPL becomes that much more important. So, Dr. Ghosh, why is it important for our listeners to know about the hidden cost? Because a lot of the research that's gone into your report, and it's pretty intensive and exhaustive research, we take it as a convenience, but as your report shows, there are hidden costs. So, what is at stake out here for us?
Sure. Yes, we always take the customer's perspective in the research. That is what distinguishes Dvara Research from other organizations. In the sense that we always ask, what's in this for the customer, and what is it going to help the customer? Is it going to hurt the customer? And remember, like I said before, even though poor customers are our primary stakeholders, all our work really has implications for the whole spectrum of retail finance customers, because the regulator does not make separate laws for middle income retail finance and poor retail finance. The regulator just makes regulations for the entire retail finance segment. So everything that we do has implications for the full spectrum. Now, we are mainly interested, of course, in the poor customer. We are also interested in women customers because women have traditionally been excluded from the formal financial system. Now, with BNPL, it is very important for customers to know about the cost, monetary and otherwise, because there are two kinds of costs that BNPL products, bring to the customer. One is the monetary cost, and second is the non-monetary cost. Now, the reason it is important for customers to know about these costs is because especially poor customers are very hungry for credit. And BNPL is a very easy way to get it, right? So customers are in danger of making hasty decisions without caring to know properly what they are getting into. Secondly, so that's the first reason why it is important to educate customers about BNPL, because they may not read the terms. As we discovered, they may not read the terms and conditions. And in fact, the terms and conditions may not even be properly disclosed to the customer. Secondly, the fact that customers are hungry for credit and that BNPL is providing that credit would not be such a bad thing if it were the case that providers were doing the right thing, which is providing the customer all of the information, insisting that the customer understand what they are getting into. But you see, on the provider side, just as on the demand side, there is a hunger for credit. On the supply side, there is a hunger for profit. So the incentive to really educate or inform the customer is often absent on the provider side. And this is why we have to do the work that we do. Through our research, we try to bring to light those vulnerabilities that customers face when they take up BNPL and similar products. See, one thing I would like to impress upon your listeners is that just because there is a demand for credit does not mean that providers should necessarily supply it, because credit is always the exchange of money today against the promise of repayment later. So we have to worry about whether that repayment will actually happen. Now, you might say that, but surely providers worry about this already. Otherwise, why would they lend? But in truth, what really happens is that providers don't worry about this as much as they should. Because, we have seen in microfinance, for instance, there is a lot of churning of loans. What is churning of loans? Churning of loans is where customers are borrowing from one lender to repay another lender. So there is no incentive for any one provider to do really hardcore, careful credit decisioning. In fact, this is a surprising fact maybe for many of your listeners, that microcredit customers are not price elastic, meaning that they don't really care what interest rate is being charged on their loans. This microfinance providers themselves tell us that the customer doesn't really care about the interest rate. Increasing the interest rate does not turn away customers. Now, this is giving you a clue that why do customers not care how much interest rate they are paying? Because they have the ability to borrow from some other lender to repay the loan that they are taking out from one lender. So then what is, now BNPL is particularly problematic because the demand for credit is usually coming from those who will spend it on consumption purposes. So it's one thing to borrow money and create income generating opportunities with that money. So there you're borrowing, but you're borrowing it for investment purposes, and therefore you're creating the capacity to repay later on. But it's a whole other thing when you're borrowing to consume, because then you have to worry about where's the money going to come from when you have to repay. So that is, most of the BNPL demand is of that nature, and this demand is being met by a product that actually does not look like credit. The very name buy now, pay later means that, or at least it suggests that interest rate is zero. You buy today and you pay the price later, we won't charge you interest, or at least that is what the name suggests, buy now, pay later. If they had said buy now, pay later with interest, it would have been a different thing. But they say buy now, pay later. So therefore, this is a problem that on the one side, you have people who are hungry for credit. On the other side, you have a product that does not look like credit. So that's why it's important to understand the hidden costs, right? That this is actually credit. And what is at stake here, of course, is the promise of financial inclusion. Are poor customers indeed being benefited or not by this new offering? And of course, what is at stake on the supply side is the future of digital lending in India, because whether digital lenders can in fact be trusted to conduct themselves properly when they engage. Because you see, the India has scale. That is the good thing about India. So that's why so many foreign investors want to invest in India, because India has scale. But how do you get scale if you cannot win the trust and confidence of especially the poor customers? So that is what is at stake here, really.
Very important, Dr. Ghosh. Thank you for that, deeply exhaustive answer. And on that note, folks, we're going to take a quick break. On the other side, we're going to talk about the report, its findings, the hidden costs, and a whole lot more on this episode of Paisa Vaisa. Don't go anywhere. And welcome back. So, Dr. Ghosh, let's go straight to the report at the crux. There's a lot of work that you've out there. The costs that customers incur in a BNPL product. Please tell us about that.
Yeah, so BNPL products are often taken to be superior to credit cards, especially by customers to whom they are marketed as such by providers. But we have discovered that BNPL products have similar pricing policies as credit cards, and they are not actually very different in terms of costs. So there are two kinds of costs that BNPL customers incur. One is the cost before the loan has been disbursed, which is pre-default costs. So these can include interest costs, processing fees, auto pay fees, joining fees, card-related charges, carry-forward interest. All these are costs that the customer can expect to pay when they buy a BNPL product. The APR on the interest cost can vary tremendously between 0 and 36%. The processing fees can also vary a lot, from 0 rupees to all the way to 199 rupees. So the processing
I'm going to
fees
just interrupt you there. Sorry, to explain APR to our listener. That's annualized percentage rate, folks. Okay, so many of you are probably used to the, if you have a credit card, you've got a monthly rate in mind, which is whatever, 1.5 to 3%. APR, annual percentage rate. Am I right, Doc, in that? Yeah?
Yes.
That's what's the important one. Please go on, Doctor. Sorry for interrupting you.
No,
I just thought it's an important point.
Yeah. So there are processing fees which can either be flat, meaning it's a lump sum fee, or it can be a percentage of the transaction amount. It can be up to 3% of the loan amount, with or without a threshold for transaction value. Because sometimes, BNPL product offer you more money than you need to complete the transaction for which you're taking the loan. And often the interest will be charged on the entire amount that is being loaned, not just on the transaction value. So other costs also can vary between 0 and 500 rupees, which are often charged as flat costs. And the other thing is that these are all pre-default costs, by the way. So this is at the time that the loan is being applied for and disbursed. These are all of the costs that the customer can hope to pay for this product. And it is unclear. See, the other thing about BNPL is that the customer is not directly borrowing from the lender. The lender is usually a bank, but there is an intermediary that is intermediating between the bank and the customer. And that intermediary is borrowing from the lender and passing it on to the customer. So it is not clear from looking at these costs what the cost sharing is between the intermediary and the lender at the back end. So these are pre-default costs. So in some ways, the BNPL model is a little opaque. I don't think even the regulator quite understands what is the nature of the contractual arrangement between the provider, the BNPL provider, and the back-end lender. Now, there is a second category of costs, which is the post-default costs. Let's say you have taken a BNPL, bought a BNPL product. Now you have defaulted. You cannot repay the loan. There's a whole set of costs that follow if that situation arises. There are late fees, there are bounce charges. According to the IT Act, all such fees can be construed as interest, by the way. Late fees are either a percentage of the outstanding amount or they can be a flat fee according to the outstanding buckets. Late fees can vary between 0 rupees to all the way to 3,000 rupees. If you actually put all these kinds of fees, all these post default fees together, the implied interest rate can go up to 50% per month. Yes, across for some providers, not all providers. Some providers it can be zero, but some providers it can be 50%.
That's massive. I mean, you're giving us the entire scale. It's huge.
It's huge. There's a lot of variation, lot of heterogeneity in this market. And then, of course, there are check bounce charges, etc., which can also vary. Those are usually flat charges, lump sum charges. So really, just to recap, two kinds of costs, two kinds of monetary costs. There are a whole set of non-monetary costs, but two kinds of monetary costs. One is pre-default costs, and the other is post-default costs. And when you actually put these costs together, you find that in the bargain, BNPL products are not that different from credit card products.
Wow, that is something, folks. And again, remember that BNPL is an easy source of credit to a lot of people, and that's why we are going deep into this. Dr. Ghosh, how is the system broken? If I can, say that the system is broken, there are people who would say that it's not. But if I take this perspective out it and I look at the cost that you have outlined for us, from your report, I saw there are two aspects. First, the TNC, what's called the terms and conditions, and second is the onboarding process. Let's talk about that.
Sure. So from a customer protection standpoint, indeed, the system suffers from several gaps that can result in the endangerment of customers, harms to customers. So in that sense, yes, we can say that the system, maybe it's not broken, that may be a little too harsh, but certainly there are gaps. There are gaps that need to be plugged. So on the terms and conditions provided by different providers differ. They can differ in length, meaning the tenure of the loan, the scope, the level of detail, that the terms and conditions go into. But they are all, we found, we did mystery shopping. Mystery shopping is where we actually buy the product ourselves. And so we had 10 of our researchers who actually bought these products themselves. And so that experience of buying the product, going through that credit decisioning process taught us some lessons. So what we are basically reporting in our work is the lessons learned from that kind of what is called mystery shopping exercise. So the terms and conditions we found are all difficult to understand. Even to us, even for us, we do research in this area, we understand finance. But even for us, those terms and conditions were quite difficult to understand. Some of the terms and conditions, because when you think of terms and conditions, you're thinking about what is the contractual arrangement between the borrower and the BNPL provider. But like I said, there is also a contractual arrangement in the back end between the BNPL provider and the lender. Those terms and conditions are not disclosed to the customer. But our proposal is that even those should be disclosed to the customer so that the customer can know what is the arrangement between the BNPL provider and the lender, so that then the customer can know what is the net arrangement between me and the lender. Now, most of those terms and conditions, back-end terms and conditions, are not disclosed. In some cases, we only found one BNPL provider. I will not take any names today, but we only found one BNPL provider who discloses these back-end terms and conditions before sanctioning the loan. And in fact, we found one BNPL provider which does not even disclose this information after sanctioning the loan. So terms and conditions are very critical because, even with all other retail finance products and services, even people like you and I probably do not always read the terms and conditions before we buy these products and services. So in the case of poor customers who are hungry for credit, this presents a definite hazard. Now, key facts and statements and important terms often are not disclosed. They're not available. If they are disclosed, they're often not properly reported, meaning that they are not reliable. Some of the BNPL providers do not disclose who the backend lender is. It's not transparent to the customer who is the ultimate lender. By the same token, if you actually look at the ultimate lenders, they do not sometimes disclose who they are tying up with on the front end. So that information is also not disclosed sometimes. Even on their websites, we went to their websites to check if they are disclosing this information. So they're certainly not being disclosed in the BNPL contract, but even it's not being disclosed on the websites of the banks. So we found that financiers, the lenders sometimes retain the right to reject applications without disclosing reasons. The burden of ensuring that this loan is actually suitable for the customer is on the customer's shoulder. So it's basically a buyer beware kind of model of customer protection. Dvara Research has, for the last 12 years, 14 years that we have been in existence, we have always insisted that this cannot be the model of customer protection, that buyer beware model, because financial products and services are intrinsically difficult to understand and difficult to make sense of, especially for poor customers, who in many cases are first-time buyers. So therefore, it is not enough to put all of the burden on the customer, on the buyer. Some of the burden has to be shared by the provider, the seller. So credit reporting, we've discovered that credit reporting practices are not disclosed to customers. We also found worryingly that when customers' data is being taken by these BNPL providers, there is no clear policy as to how the BNPL provider will handle this data. So data protection is an issue. Of course, in India, we don't yet have a data protection law. So that's, of course, at the macro level, that's a serious gap. But even at the micro level, we find that BNPL providers are not disclosing what kind of data protection protocols they have in place and whether those data protection protocols are truly meaningful protocols. And finally, we even found that sometimes potentially unlawful clauses are hidden in the fine print. So for instance, with one BNPL provider, we discovered that the provider was waiving away any protections against usury. Usury, as you know, is charging very, very high rates of interest, criminal rates of interest. And if you look at the fine print, you find that the provider is waiving away, any protections against that kind of activity. So these things caused us to really perk up and take notice that this is what is going on. And that's why we wrote this report, to bring attention to this industry. Of course, now the RBI has acted. You may know that in the last few weeks, the RBI has taken some strong actions. We believe that those actions are in the right direction, and many BNPL providers are in fact disciplining themselves as a result of these actions. But this was the condition of the industry when we found it.
Wow, waving away the right to use. I mean, that's really something. The one thing that I noticed in your report, Dr. Ghosh, is that there's credit inclusion that happens thanks to BNPL, but with all of this, it makes credit less accessible, less affordable. Now, those two things
That's
are quite
right.
important, right? Let's
That's
just,
right.
we are winding up on the episode. That just talk about this because it's very important. Maybe, I don't know, our listeners might be more tech savvy, so they can probably get this a little bit more. But for people who are not used to credit products, the promise of credit inclusion is to make it accessible and affordable. Probably that's what BNPL had in its mind when it came in, but that might not really be the case. Let's talk about that.
That's true. So, like I said earlier, what is at stake here? At stake here is the promise of financial inclusion, right? So yes, on BNPL is a wonderful product if it were to work properly, because it does promise credit inclusion, especially for segments who do not have credit histories, which is very important. As you know, that if I want to borrow, I need to have a good credit score, and I can only have a good credit score if I have a credit history. But in many cases, BNPL customers don't have good credit histories, and the promise of BNPL is precisely that despite not having good credit histories, we can still make you this loan, because we are able to see what kind of transaction you're doing, and maybe your transactions history can teach us something about your credit worthiness. But what's happening is that every opportunity to solve a problem is also, worryingly, an opportunity to create new problems. So what happens is that in the preamble to actually do a good turn for poor customers, somewhere that initial intention becomes lost, and profit making and making a quick buck begins to take precedence. And now what that does ultimately, and of course it's because of that mentality that you don't, that you have all of these problems with the terms and conditions, the disclosures, the hidden costs, and all of these things, right? So how does that belie, let's say, the promise of financial inclusion? The way it does so is exactly as you pointed out, that it makes credit less accessible, less affordable, and less suitable as well for poor customers. See, suitability is very important, because suitability means that what you're selling to the poor customer should be suitable for them. Just because they are expressing a demand for it does not necessarily mean that it is suitable for them. Sometimes we want things which are very bad for us. So that suitability check also should be done by the provider. But like I said, sometimes it is hard to expect providers to do all of that due diligence and not rack up costs that would then not allow them to make a profit in this kind of business. So I think what is at stake here is the promise of financial and digital inclusion. BNPL is not a bad product per se. Intrinsically, it's not a bad product, but a lot more cautions need to be exercised, both by the regulator and by the customer. And certainly the conduct of BNPL providers has to improve significantly if the promise of credit inclusion is to be realized.
And Dr. Ghosh, you know what? This is reminding me the movies of the 60s and 70s, the Hindi movies, that is.
Yeah.
They used to feature loan sharks and money lenders as evil. Okay, I don't know if you've seen Mother India, but I mean, the story of Mother India featured a loan for a wedding that went on to ruin that family. When I think about that, and I think about, they seem more transparent than this. I mean, I know that they're charging a very high rate and the cost of default is definitely higher out there, but BNPL is just a loan. And when you put in shrouds and layers and terms and conditions and all of that over that, and you've got these kind of costs for people who can afford it. Of course, it's a great thing for people who are educated. It's a great thing for people who need all that is fine. We've covered that on our podcast. But for people who are not able to understand it, I just hope that this goes, it grows better going forward, because we know that credit is needed. Financial inclusion is a big thing, of course, but credit inclusion, any thoughts on that, Doc? I mean, has
absolutely.
anything...
We are not painting BNPL providers with a broad brush. Certainly not. We are acknowledging that BNPL can be a good vehicle for credit inclusion. But as usual, in any kind of for-profit activity which also seeks to do a good turn, there is always this sort of conflation of motivations and a conflict of interest. And I think what the regulator needs to do is just make sure that this conflict of interest is not hurting customers, because if it hurts customers, it will not achieve the good outcome, will not come to pass. So certainly, I think throughout history, not just movies but books, literature, the concept of debt and loan sharks and distress has been the favorite of artists and authors and playwrights and film directors, etc.
Yeah, and they also reflect reality in a certain sense. Okay,
absolutely.
Dr. Ghosh, winding down this episode, you've written this report. Dvara has written this report, and there's a lot of data out there. It's publicly available. So, folks, you want to just check out the report, Dvara Research. Go on the website and download the report and have a look at it. Dr. Ghosh, any tips or advice for our listeners on how to be careful?
Yeah, certainly. So certainly I would say, based on everything I've said so far, I think the message that should come through very clearly is be vigilant, be informed, be aware. Financial products and services typically do come with a lot of strings attached. Educate yourself about what it is you're buying, what it is you're purchasing. Now, I might also make a deeper suggestion, and that is that digital and financial inclusion, as we have come to learn in the last decade or so, comes with its own problems and its own hazards. It is not an unmixed blessing. One way to bring these hazards to the attention of the regulator is to actively report your own personal stories of negative experiences with these retail finance products. So if you are buying these retail financial products and services and you're having negative experiences, do report these negative experiences. You can obviously use social media to bring light to these negative experiences. But better still, you can actively use the grievance redress mechanisms that banks are offering and that the RBI is offering. A lot of people don't know that there are grievance redress channels that are available to them. Granted, these channels are not always very efficient and perhaps even not effective. Well, if so, then report those experiences as well. Use these grievance redress channels and report also your experience of using these grievance redress mechanisms. See, because our experience of talking to regulators and policymakers is that ultimately policymakers and regulators do want to do the right thing. But they are putting out so many fires at the same time, all the time, that unless they get this information from the public that, okay, these are the problems, these are the grievances people are reporting, they might not actually take any action. So it is very important to get the negative experiences that customers are experiencing with retail financial products, get it on the radar of the regulators as much as possible. There are various different channels that have been created by the regulator themselves to make this possible. Use those channels, report your experiences of using those channels. And I think that is how we can all participate consciously in this advance that India is making towards digital inclusion, financial inclusion, so on.
Yeah, and folks, most importantly, take care of those who are vulnerable to this. If say you've got your domestic help, you've got, I don't know, if you're an MSME or an SME person who runs a factory, you've got employees, they might not be that savvy with these products. So just keep a watch out for them. It's very important for you to guide them so that they're careful. They're also probably new to credit. They don't have a credit score and maybe they fall for a BNPL product like this. But folks, that is a wrap on this episode of Paisa Vaisa. My guest, Dr. Indradeep Ghosh, Executive Director of Dvara Research. Dr. Ghosh, thank you so much. Really, thank you so much for doing this for our listeners.
You're welcome, and thank you for having me.
And listeners, if you like this podcast, don't forget to check out other interesting podcasts on the IVM network. You can listen to us on the IVM Podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcasts on Twitter and Instagram. And if you want to reach out to me, I'm your host, Anupam Gupta, B50 on Twitter. And thank you so much for listening to Paisa Vaisa.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment